You guys asked for it, so in this video, I'm gonna be going over hedging your position so you stop losing money on the downside. Let's get straight into it. So if you guys are still trading short dated options for a reason, this video probably won't be too beneficial for you, so I just recommend clicking off while you can and not wasting your time any further. If you guys trade options that expire in 6+ months, leaps, things that expire in over a year, or if you're just trying to hedge your downside risk in your long-term portfolio, this video will probably be pretty helpful and you won't panic sell during a market downturn. So really the main purpose of hedging your account, hedging your position, is just protecting the money you already have and protecting the money you've already made. So sometimes if you're trading names like Nvidia, Tesla, etc., they can get pretty volatile, and if you're not able to manage those short-term swings on your position that expire in over a year, you're probably going to end up panic selling and losing more money than you would have thought. And one of the main benefits for hedging your positions is it reduces emotional trading. One big thing for me is because I like buying options that expire in a year. Sometimes names like Nvidia, Apple, Tesla, etc., they get pretty volatile. You can see pretty big swings in your P&L in your account, but just by buying a couple puts and hedging your downside risk, you can mitigate all the downside, collect some cash premium in your account, and then wait for the market to bounce back like it has the last few years, and just ride your leaps back to the upside because you bought time on your contracts or because you're holding shares of the underlying stock you're trading. So let's get straight into it. Waste no more time over here. Get over to the computer. So one of the biggest things when it comes to hedging position is timing your hedge. You don't want to be buying puts down here at support. I see lots of people doing that. They don't understand what the market is. They don't understand the market context. If you're buying puts and trying to hedge your position, you want to be buying puts at resistance and when you expect sellers to step in the market. So if you're wrong, you lose a small amount of money and then your long position just keeps going up, with the rest of the market. That's one big thing to focus on. So if you're looking at like the NASDAQ right now, if I'm looking to hedge my position and looking to buy some downside risk, buy some puts, one thing to focus on is buying puts. As of this time, I'm recording this video at like 21,700. Don't be buying puts down here because that makes no logical sense from a risk reward aspect. And this is typically how it goes when I see people try to hedge their positions. They buy puts down here at support. They sell their calls for a loss down here as well. They sell their calls down here. So not only do they sell their calls for a loss at support, they buy puts at support, and then they watch the market bounce all the way back up on them, and then they start panicking like, oh my god, I missed the whole move up higher. Now I'm trying to go long back in the market, and then they just repeat the same process over and over. They buy more calls at resistance, market goes down, they panic sell their calls down here for a loss, they start buying puts down here, the market bounces, makes another higher low, and they keep doing the same thing on repeat over and over and over. If you guys are trying to hedge your positions, again, you need time in your contracts or just holding the underlying stock, and you need to be able to identify where the market resistance is and the context of the market. Right now on the NASDAQ, you kind of been barcoding sideways the last few months. Obviously, it's kind of a bit volatile, but you can see you're in a pretty clear range right now on the NASDAQ. You come down to support around 21,000, bounce back up, and find resistance around 22,000 and sell back down to the downside. So understand the market context and how we're moving. If you're in a clear range on the NASDAQ or whatever equity you're looking at and you're trading sideways in a clear box, what they say, keep it simple, stupid. Buy puts up here, hedge your risk. If you're wrong, just stop out for a loss up here. If you're right, you just sell down at support. So now let's flip over to equity like Nvidia. Nvidia is one of the largest holdings in my long-term portfolio, and I really like trading Nvidia a lot. But I can also identify when Nvidia is coming into resistance. It might find some turbulence, and I want to protect my downside risk. So one other thing you guys can look at is moving averages on the daily and weekly time frame. Don't look at moving averages and try to hedge your position based on the 15-minute time frame. It's not going to work for you, and you're going to end up losing money. Again, higher time frame stuff here, guys. We're not trading weekly contracts. We're not trading 2 weeks out. This is to protect your accounts in the long-term portfolio and leaps and contracts that have over 6 to a year in expiration. Again, just to reiterate, because some guys don't like to listen to me. It is what it is, but you're watching my video at the end of the day. So take it or leave it. I can't help you. As bullish as I am on Nvidia, I can recognize that the moving averages play a pretty critical role here on Nvidia's price action. So for example, when I recognize Nvidia is coming down to the 50-day moving average and about to break it, I'm going to start protecting my downside of my contracts and my shares by buying puts around the 50-day moving average and then trading it back down to the 100 because you found support once down here, twice down here, 3 times down here. Then you kind of chopped around down here around the 100, and same thing down here going back to September. So same thing here. If I'm protecting my downside, I want to buy puts around resistance, which is the 50-day moving average right now, and then selling them at support, which is at the 100. I'm not looking for a major downturn, another 20% drop on Nvidia. I'm just looking for a quick move to the downside, selling at support, building my cash position up a bit higher so I can have more money. If Nvidia bounces, I can average into that position a bit more. And then when Nvidia inevitably bounces, because that's what it's been doing the last 8 months, it comes down here in this rectangle, finds support around 130 and bounces back to the upside. I just sell all my puts down here at 130 and just do the same thing over and over until I finally get the move I'm looking for. Now let's zoom out here on Nvidia. One big thing for me I kind of had a hard time with last year when I was trading pre-split, I kept on getting chopped up in this range here on Nvidia between $50 and $40. But keep in mind at the time, it was $500 and $400, about like a $100 range. So I kept on anticipating the breakout up here at like $500. It kept on getting rejected. So all I did in this position was I bought like a leap around. I already made a video on this position I bought that I made $20,000 on, but I'll go over it kind of again right here. But I just bought like a leap right here for like $90 a contract. My stops are down here at low of the range. And then when Nvidia inevitably broke out, I was able to capitalize on that move because this whole time when Nvidia was pulling back, hitting resistance, I just bought a couple puts up here to hedge my downside risk when it pulled back down to the 50-day moving average and 100. And then once Nvidia ended up breaking out, it went straight up to the upside. I hedged on the downside risk, built up my cash position, and then I was able to sell for a $20,000 profit on top of making all that cash I was on the puts to the downside, protecting my capital and managing my position I already had going for me previously. The second biggest thing I'm looking for when I'm trying to hedge my position is I'm looking at the delta on my contracts and the delta of the hedge I'm looking to buy. So right now on Nvidia, I have the June 2026 contracts that expire in about like 18-ish months, about like a year and a half. Because I like buying in the money positions because I get more leverage and I like to let my cash work for me a bit more aggressively in my portfolio. But the delta on those two contracts, or however many contracts you're buying, is going to be about like $80 a contract, or like 75. It's going to be about 75 per contract. So if you have two contracts, the delta is going to be about 150. So that means every dollar Nvidia goes up or down, I'm making $150 to the upside or downside just based on the delta alone. So knowing that, if I'm looking to hedge my position, I'm looking to buy puts that are kind of close to the money as well, not super far at the money. I'm trying to match the delta or go slightly around the delta. You're not trying to make a bunch of money in this position. You're just trying to mitigate your downside risk and not lose money in a short-term market downturn or when the market starts pulling back on names like Nvidia. So again, for example, when Nvidia's pulling back here, because I have the $100 calls, the delta's about like 140 hypothetically. If I'm looking to hedge my position on Nvidia, I'll probably, as of this moment, I'll either buy a February or March monthly expiration. And right now, because Nvidia is trading around like 135, I'd probably buy the 130 puts, and the delta of those puts will match the delta of my long calls. If I have a delta of a negative 150 in the puts and the delta of 150 in my calls, negative 150 plus positive 150 equals 0. So that pretty much means if Nvidia drops $5 to the downside, my long calls will be down $650, but my puts will also be up $650, so mitigating the downside risk. And then I just sell at support and rinse and repeat until Nvidia eventually gets the move I'm looking for, which is breaking about 150 and going to the upside. And the big thing to remember is when you're hedging your position or your account, you're only protecting for temporary downside. You're not looking to make 1,000, 2,000% on these puts to the downside. You're just looking to build up your cash position, get a couple $100 depending on your account size, mitigate the downside risk, and then rinse and repeat and wait for the market to bounce back up higher and keep on doing the same thing till the market just keeps going in a trending direction. Don't try to go into hedging your account and try to make a bunch of money looking for downside. You can scalp the downside, that's for sure, but again, the primary goal of hedging your account and hedging your positions is protecting the money you've already made and trying to keep your account net neutral as you go through a market downturn of about like 4 or 5%, or even as you experience volatility in names like Nvidia and Tesla, which can get pretty volatile at times. And the next big thing to keep in mind is your position size. So one big thing I also see that people do wrong is they try to match their overall position size in their long positions and try to trade all that to the downside. Again, because you're taking contracts that expire in like less than a month to hedge your position, you won't need to put as much capital into your puts because they're short-term options expirations and they won't cost as much money. So for example, right now I have about like $10,000 in my long calls on Nvidia. But if I'm hedging my downside risk and I'm buying the 135 puts like I mentioned, I'll probably want to have to put in like $3,000, $4,000 to buy 6 or 7 contracts, and then just trade that back to the downside and sell for like a 10, 15, 20% win, and then just keep on doing the same thing over and over until Nvidia keeps on bouncing back to the upside. So that means, again, if I'm going short, short $4,000, again, you have to keep in mind the position sizing. Try to hedge about like 30 to 40% of your long calls and keep it around that area. Some people like to do smaller, some people like to do much more. But for me, I found that 40%, 30% is a good target area to hedge my downside risk and also make some decent money if the market starts going down or if like Nvidia starts dropping. So around 40% is kind of that big key number for me and what works well for me when I'm trying to manage my position size. Again, this may be different for you guys if you have smaller accounts or smaller, or larger accounts. So just, you gotta find that balance and do what works for your position and what works for your account. So for example, If your account's like $5,000, maybe go short $2,000 to protect your downside and try to keep that, ratio a bit more balanced. Or let's say your position's long 20,000, maybe you put like $6,000, $7,000, $8,000 to manage your downside. Again, just gotta find that ratio that works for you and what works for your account size and your position size. So some common mistakes I see, I'll just go over pretty briefly. Again, people buying puts at support and selling at resistance, doing everything wrong. If you're trying to hedge your position, be buying at resistance and selling at support. Always keep in mind that. And again, keep in mind that you're just trying to mitigate your downside risk in the short term of market pullback. You're not looking for a major market crash like we saw in 2020 or like a major or a pullback we saw throughout 2022. If the market started moving in the fashion of 2022, again, I'd probably be out of most of my longs in my trading account and just be buying a dip in my long-term stock portfolio. But because the market's been going up the last 2 years, if I'm hedging my account, I'm just trying to catch that 1 to 2 days of downside, get some cash back in my portfolio, and then wait for the market to rebound like it has been doing the last 2 years since October 2022. Again, this really just goes back into being greedy and expecting much more of your position. Take the small win and keep in mind the bigger picture, like Lil Baby said. And you have to keep in mind, like I kind of talked about, the market context. Don't waste money on hedging during normal volatility. It's not going to work for you. Again, you're probably going to end up, getting emotional, selling your put to support, buying calls of resistance, and you're going to keep on losing money both ways because you don't understand the market context and what's actually within the underlying market or equity. And then so just a few points before we wrap it up here. Just some more alternatives you guys can use if you guys aren't comfortable buying puts. You can use inverse ETFs on a bunch of different names. For example, like TLSL, TSLS is a Tesla inverse. So if you're trying to hedge your downside on names like Tesla, you could buy shares on this name if you guys can't buy puts for a reason. Or like NVDS is also a daily short ETF. Again, interesting pick here because NVIDIA usually goes up over time. But let's say you recognize that NVIDIA was coming in some resistance around 150. You could have bought like some shares around $21 here on the NVIDIA stock right here. Rode that up to $25, got about made a 22% return on your money, and then as you came into support on NVDS, just sold all your stock and keep on doing the same thing on repeat until Nvidia finds some buyers and bounces back above the 50-day moving average. One thing I also like to do just to mitigate some risk and so protect my downside is selling calls against my leap. So one thing I'll do, I don't do this as much now because Nvidia is pretty inexpensive nowadays, but back when Nvidia was trading pre-split, sometimes when my calls were pretty deep in the money, I would sell some calls pretty far out the money, just collect that premium because I was anticipating Nvidia to go up further, and I can make money as Nvidia just kind of stagnates or goes sideways or drops a little bit, and I can still keep on riding my long call back to the upside because I can understand the market context and where Nvidia is going. So that pretty much wraps everything up on here. So let's take it back over here. So hopefully you guys found this video beneficial. Now next time when there's a market downturn, you won't panic and sell all your positions for a loss. You can just buy some puts, hedge your downside risk, and wait for the market to bounce back up like it has the last few years. So if you guys like this video, found it relatable in any way, found it beneficial, be sure to drop a like, comment, subscribe, and stay tuned for the next video. Peace.